Hi, we're going to talk about mortgage insurance. Mortgage insurance is when somebody's putting less than 20% down, it's necessary to have mortgage insurance on the loan. A mortgage insurance company is separate from the lender. If you default on the loan, the mortgage insurance company is going to help offset those fees for the lender to take that property back. So that's what the mortgage insurance company does. It's not a policy that's going to pay you. It's not a policy that's going to insure your down payment. It's a policy that's there if the house goes into default because you stop making payments. It's there to help the lender. This entices a lender to give you programs that are less than 20% down to help you get into a house. So on the mortgage insurance, it's costing you every month. That fee is going into your payment, and that's affected by your debt to income ratio. So it will have an effect on how much house you can buy because obviously you're making that payment like any other debt. The mortgage insurances are generally based on a 25 to 35% what they refer to as coverage. Certain programs have a discount coverage which brings down the cost of that mortgage insurance. Both Fannie Mae and Freddie Mac have special incentive programs that reduce that coverage down to 18 all the way down to 12% coverage on it. FHA on their mortgage insurance, FHA is actually doing their own mortgage insurance, and so they're offering a rate of 0.85 regardless of what your credit score is. That's their fixed rate. And when I say that that's a rate, it would be 0.85% of the loan amount that you're borrowing, and it would be divide that by 12, and that would be your monthly payment. So that's how they're figuring it. It's a percentage of the loan amount divided by 12. There's your monthly payment that you're going to pay for that mortgage insurance. The tax rules have changed, and to be quite honest with you, I'm not sure how that's going to affect the mortgage insurance. Previously, you could write off the mortgage insurance on your taxes. I'm not sure going forward if that's going to be something that will be available or not. On the good note, they increased the standard deduction, so that's nice. But I'm not sure how the tax ramifications will be on that mortgage insurance. I'll definitely update it when we find out more. Right now, it's just going to be kind of trial and error and see what happens. On the mortgage insurance, when you're getting into down payment assistance programs and things like that, you're also going to have mortgage insurance that's going to be needed on those loans. And again, these programs have negotiated better terms with the mortgage insurance companies. There's dozens of mortgage insurance companies out there, so it's best to have it checked, across 3, 4, 5 different ones to see which one's offering the best rate, depending on the loan program that you're using. Mortgage insurance is just kind of a necessary evil if you want to get in for less than 20% down, which some 85% of home buyers do it that way. So it's a great option to have. I just wanted to make sure that you understood what the mortgage insurance was all about and how it worked in there. Because it's a rate that's based on your loan amount, it's not the same for everybody. So somebody's buying a $100,000 house obviously is going to pay less on mortgage insurance than somebody that's spending $400,000 or $500,000 on a house. So that's it on the mortgage insurance. We'll see you in the next module.